Same old, same old.
Okay.
We have maybe about 95 students there, and everybody else doing virtual.
Okay.
And, they having a prom in 2 weeks,
Uh-huh.
and they can't have a date. No date and no food.
What?
Lord.
Yeah, what kind of prom? No date. No, you can't bring a guest. No guests,
Oh
and
Lord.
they're not having food.
Do you have to have a mask?
Yes.
And
Yeah.
you only can dance 6 feet apart.
Now,
Yeah.
Al, don't you have a kid over there, or did they graduate already?
Now they graduated.
Okay.
Both of mine are done.
All right.
Mm-hmm.
Hey, Sue,
And
you
they
know,
said, mhm.
Sue, I'm sorry. So you know this is saying that it's recording right now, right?
Yeah, I mean, the recording is separate from the live.
Okay.
Okay.
Yeah.
'Cause it says,
Okay.
it also says live on custom
Yeah.
live streaming services. Okay. Okay.
I think we might be okay now.
Okay.
I'm glad we weren't talking too bad.
Yeah.
And
We officially started the meeting. Okay.
right.
So I think we're good.
It's not like that meeting in San Francisco when all those people were talking about the the parents and all of them got fired.
Okay, we are good. Very apologies for the delay, but we are good.
Okay, great.
All right, welcome back to the meeting. This is the monthly
Investment.
monthly investment committee meeting, and we are going to turn it over to Kristen. If anybody else has any questions, we're going to turn it over to Kristen. And you all received the materials, and Kristen is on you now.
Thank you so much. Appreciate it. Good to see everyone. Thought we would start with the search because we do have people that are sitting in the waiting room. And when I say people, we have two firms that we're reviewing today. Bain Capital Special Situations Asia Fund 1. We selected them as a potential value add manager for your portfolio. Just as a reminder, we have 10 million in private credit for 2021. So we are recommending for consideration two managers for that $10 million. So one of them is Bain Capital, and the other is Crayhill Principal Strategies Fund 2. And they also are additive to the portfolio. They are a niche lending manager, which we don't have a huge exposure to either. And they are also Latino owned. So just as a reminder, Bain is Special Situations Asia. You don't have a lot of Asian opportunities within your fund. And so that was a bit of a gap. So that's why you're seeing them today. And then you're also seeing Crayhill, which is niche private credit. They will both explain what they do. They're both in the waiting room. So we'll just take one first. Probably alpha order is fine, but Sue, I will lead it to you, but I just wanted to remind you what we were doing. And again, this is for our private credit allocation, total of $10 million that we have to allocate towards or during 2021. So we're really looking at, if we're looking at two, we're looking at a split of 5 million each, if you choose to move forward with both of those firms.
And did you give them a time limit, Kristen, on their presentation?
Yeah, so I told them between 20 and 30 minutes.
Okay.
But I will reiterate that when they come online.
Okay. So what's the pleasure of the board? Do we want to start with Bain in alphabetical order?
Oh, Al, that's your call. You're the chair.
If that sounds good to me. Was Bain the first one in? Whoever was in the waiting room first?
Actually, yeah, it actually was Bain. Kyle Betty, he's with Bain, right?
Yes.
Okay.
Okay. All right. So I'll let him in then. And there's two of them from the other. Good afternoon.
Bobby, can you go on mute? And Mr. Cross, you're not on mute either. Chairman Cross.
Okay.
Good afternoon, Kyle. How are you? I'm Kristen Finney Cook with an EPC.
Hey, Kristen. I'm great, thanks. How are you?
I'm great. First, want to thank you for your patience. I know we're starting just a tad bit late, but we had some technical difficulties, so appreciate you being patient with us.
No problem.
We have already been prepped. The board has already been prepped as to what you'll be talking about. So maybe, as indicated by Oliver and team, if you could just go over your value add, exactly what you're going to do and how you're going to garner that value, we would appreciate it. We do have your presentation. We have right around 20 minutes, and then we'll leave a few minutes for questions. I will acknowledge that the trustees might ask questions throughout the presentation as well. So hopefully you are comfortable with that also.
Yeah, absolutely. The more interactive, the better. Feel free to interrupt me or chat me via Zoom or whatever's easiest.
Okay, and as you discuss sort of your value add, and given that this is predominantly in Asia, maybe giving the breakdown of where where you're going to be focusing on what percentages within Asia, A, and then B, just just a little tidbit on why Asia. We've talked about it, but again, this is one of their St. Louis's entree sort of specialty. Or dedicated investments would be one of their dedicated investments should they move forward into Asia. So appreciate that.
Terrific. All right.
Okay.
Well,
Thank you.
Well, let me start by just saying thank you to everybody. I first thank you to Kristen and the team at NEPC for giving us the opportunity to compete for your business, but more importantly, thank all of you for your service during these really highly stressful times, particularly for police, fire, first responders, and all really municipal employees. I know you guys have had a long year, so thanks for all of your dedication and efforts. My name is Kyle Betty. I'm a managing director here at Bain Capital, based in Boston. I've been with the firm for 14 plus years, and I'm really excited to talk to you about our Special Situations Asia strategy. Given we only have about 20 minutes, I'm going to sort of give you the actually, Kristen, do you want to let me share screen? That way I can control the slides. It might be easier.
If you just tell me
Okay.
where you want me to go, I'm good to move forward when you need me to.
Great, thanks, Susan. Why don't we start on page 5, if that's okay?
Okay.
And I can literally give most of the presentation off of these slides, this slide alone. But so for those of you who aren't familiar with Bain Capital, we are a large global alternative asset manager. We have $120 billion in assets under management, founded in 1984. So we've been around, and we have 18 offices globally, and have very deep resources as a firm. And one of the reasons that we think Asia presents such an attractive opportunity is because, quite frankly, it's the least efficient market that we compete in globally. And we have a long and rich history in the region. We've been investing in Asia since the early to mid 2000s, first out of our private equity business and then out of our credit business shortly thereafter. And the reality is the markets there are just not as sophisticated as the United States and Europe and North America broadly. It's sort of like the high yield market was in the US and in Europe back in the 1990s. And you really have to be local. It's critical. It's a message you'll hear throughout this presentation. We have 85 people on the ground. That's really our unfair advantage in the region. You can't invest in the region, using your Bloomberg screen out of New York or even London. And that's why we've made such a large and substantial investment as a firm in the region, because quite frankly, the returns are as attractive as anywhere that we invest. For those of you who aren't familiar with the term special situations, really, it is a bit of a catch-all. I can understand why. I like to simply think about it as situations where the availability of capital is more important than the cost of that capital. And Asia is a great example of that. For the last, really since the global financial crisis, the banks in Asia have been really retreating. Unless you're a borrower that's looking for a very formulaic loan that fits into a box very neatly, it quickly gaps out to private equity as a solution if you're a company looking to raise money or capital for your business. And there is an area in between those two that we participate that really is very attractive for our capital and yours. And I should say we always lead with our own capital first. One of the first principles as a firm is we won't launch a new fund or a new strategy if we're not willing to put our own capital behind it. And we have deficit spent in Asia building out this team because we think it's a really attractive place for us to invest our own capital as well as our limited partners. Collectively, we've invested over $4 billion out of the strategy in the region, generating very attractive high teens returns for our funds. You'll see our first fund has actually slightly exceeded that because of the environment that we've been investing in, which we're really pleased with. We do think it's very complementary, I'm guessing, to most of the exposure you have in your portfolio today. It's very uncorrelated. Asia is its own separate set of even sub-economies. And I'll get into a minute the areas that we focus within Asia, but really in reality, their capital markets are very immature. And that provides interesting opportunities for our capital, and where the complexity of the region, quite frankly, scares a lot of our competitors away. And we really, in the US, we probably compete with 25, 30 scale competitors in our asset class that are very good at what they do. In Europe, that's probably 10 or 15, very high quality, very credible competitors. In Europe, in Asia, it's probably 3 or 4. So it gives you a sense of the order of magnitude. And we really divide our strategy into 3 kind of sub-deal archetypes, and which I'll go through in a minute. But before we do that, for Kristen's point, I just want to spend a minute, if you could turn to the next page, walking you through why we think the region and putting some data behind it. As we sit here today, coming out of COVID, banking systems everywhere are stressed, but particularly in Asia. In the US, actually, the banks have fared fairly well because they were fortified coming out of the 2008 crisis. That's not necessarily the case in Europe, and they're far less competitive with us there than they are in other markets. And that has accelerated the creation of opportunities for us. Unless you fit neatly into a box, as I said, there really is no liquid senior loan market, if you're familiar with that in your portfolio. I don't know if you have bank loans, or high yield bond market in Asia of any scale. So it really relies on private capital providers like ourselves to fund businesses when they're looking for a debt or an equity solution. Oftentimes, they're very a lot of the businesses in Asia are still entrepreneur and owner-backed businesses. Most of the companies that we finance, at least. And therefore, they're really hesitant to give up ownership. And so, having some sort of a very expensive credit solution is often a good option for them. The credit cycle is turning in Asia. You probably read about some of the ghost malls in China that were financed by the big infrastructure build out over the last 10 years. That's coming home to roost a bit. One of the opportunities that we see that we're pursuing is the opportunity to buy non-performing loans. So think of it as a mortgage against a large real estate project that has gone bankrupt, where you're secured against the assets, but you can buy them at a deep, deep discount. So typically, we're buying them at a 30 to 40% discount to what we believe their current value is. And there's a large scale volume of NPLs that the banks are sitting on in China and in India. In India in particular, it's estimated that about 20% of the banking system is in non-performing loans today. In both India and China, a lot of the banks are state-owned banks, and therefore they don't always disclose their problems. But what it's done is it's prohibited them from being able to also make new loans. So we're cleaning up the bank's excesses, but we're also filling the void where they are no longer participating. The core markets that we focus on are really China, India, parts of Southeast Asia, Korea, Australia, New Zealand, which is obviously not part of Asia, but part of the broader APAC. And we think taking a pan-regional approach really makes sense from a diversification standpoint. There are funds out there that just target non-performing loans in China or just target distressed in India. The beauty of this is it gives you a turnkey exposure and a more diversified manner to the broader opportunity set in Asia. And that's really hard to do because, as I mentioned, it's really critical to have boots on the ground in the region. People with local language skills, with local diligence networks. Asia is not one monolithic thing. Each country speaks a different language, has different business practices. And so we've literally spent years building out that presence and now have real bears around our business, which is really great. The other dynamic at play here is just we have structurally lower competition from the investment banks. At its peak, there were probably 11 or 12 investment banks in the region that were highly, highly competitive because they had a vertically integrated relationship with many of these, entrepreneurs and business owners, where they did their private wealth. They also financed their business. They, interface with them in many ways. coming out of the global financial crisis as banks retrenched to their core markets. So if you were HSBC, you were obviously still focused on Asia, but if you were a Lehman Brothers, you went away. If you were, BAML, you're retreating to, basically North America for your focus. And that left a real capital gap that we've been able to step in and fill. And we also have very few competitors in the region, as I mentioned before. So if you turn the page to the next slide, Susan, I can give you a little more data around that. So these are the credit markets, the size of the credit markets in the US, Europe, and Asia. And then in the dark blue, you can see the amount of fund capital that's been raised by managers like ourselves. And you can see the US is a pretty competitive market. It's a big market at $37 billion or trillion dollars. But there's also been a lot, or $1 billion, sorry. There's been a lot of capital raised, 267 billion just in the last 4 years alone. And then Europe's obviously a smaller market opportunity, but there's been a lot of capital there. The Asian markets represent roughly the combined size of the US and Europe together. And yet the amount of fund capital that's been raised by competitors is only around $34 billion. So bigger market, fewer competitors, and that's, really in a nutshell what creates the opportunity for firms like ours. You can turn the page to the next slide. The other dynamic at play in Asia is that you actually, most countries in Asia, with the exception of India, have come out of COVID in a better position than North America and parts of Europe, mostly because they have very strict lockdowns early on and have a lot more of an, obviously more of an authoritarian government, but also more of a rules following based population. And that's not a political statement, it's just sort of, you can see it in the data. Growth has come back to Asia much quicker than it has in the US and Europe. At the same time, high yield spreads, and again, this is not a great proxy because the market in Asia is not big or diverse, but nonetheless, you can see the spread over risk-free rate that you get for lending to Asian companies is actually much wider than it is in the US and Europe today, despite the fact that valuations are far more attractive. And so I think the combination of those factors to us, gets us excited about this market. So maybe just turning to page 9 on the team real quickly, and unless there are any questions on anything I've covered so far. I know I'm talking fast. I'm trying to be conscious of time, but please, feel free to interject with questions. So as you can see on the page here, it's a very big team. I think what's important to point out is that when we're staffing a deal in Asia, not only is it someone from the dedicated Special Situations Asia team, which is about 80 people today, we are generally staffing it also with someone from our industry research team. So we have 36 people who sit in our industry research effort and think about their industries all day long. They're experts in healthcare and aviation and in technology, et cetera. And then someone who has domain expertise. So if it's a distressed deal, making sure we have our restructuring specialists on the deal. We have deals where we've had more than 10 people from across the firm, including people in our private equity business who have worked on transactions. And there's just not many of our peers that can, going back to Kristen's point on what our value add and what our unfair advantages as a firm, it's the fact that we can staff these deals with such a deep and experienced team. So we have deep industry expertise, we have deep in-country expertise, and they're locally situated in market. And then we also have some domain expertise in real estate, for example, where we lend against real estate, as I mentioned, in the strategy as well. And that's obviously all supported by a very deep operational, legal and compliance infrastructure as well. Maybe turn to the next page. So I'd like to just stop and spend a minute on this slide because I think it really gets to the heart of the strategy. We categorize our Special Situations Asia strategy into kind of 3 deal types, and these are not equally weighted. Capital solutions represent roughly 2/3 of what we do in any given fund. What these are not companies in distress per se. These are companies where, again, the availability of capital is more important to them than the cost of that capital. And the reason for that usually comes down to complexity, some sort of complexity around the transaction. And I'll give you some examples in a minute. But they're typically either corporate cash flow driven or they're real estate or hard asset backed, which we love. So we have security in, if it's an aviation deal, the planes, if it's a real estate deal in the actual hard asset real estate. And in many of these jurisdictions, we get the question a lot, how are you comfortable lending against them? There's really good rule of law it's actually, even in, China, when you're repossessing real estate, if you're having to go through a court process, and we don't do anything with residents or individuals, we're dealing with companies. There's a very court tested and very actually streamlined process that looks very much like a lot of the Western bankruptcy processes. So these are highly structured transactions. Everything we're doing in this bucket is a bespoke loan. So we can make sure we have guarantees against the entrepreneur's assets. Or if it's a corporate, we have guarantees against the corporate assets at the company level. And we structure them with generally fairly short duration, with protection to the downside, but also upside if the situation goes well. And that upside generally comes in some form of equity participation or warrants if things go our way. And I think the best way to maybe communicate it to you is maybe through an example or two. You can see Schwan's there. You may be familiar with that brand because it's a 50-year-old North American frozen food company that makes Mrs. Smith's apple pies and a bunch of frozen pizzas. And if you look at their website, you'll be very familiar. They used to deliver actually a lot in the Midwest. You see their yellow trucks around, especially the upper Midwest. So Schwan's was being acquired by a Korean conglomerate, and they were looking for a global partner with a U.S. presence to partner with, really to help with on the operational integration. We were approached on the deal originally in our private equity business, and our team liked the business, but it wasn't growthy enough for what they do. It is the category until COVID, quite frankly, was actually a fairly slow growing category. The reason that was interesting to this Korean company was because they were looking to get distribution into all of the U.S. grocery markets. So whether it's Kroger's or Stop and Shop, or I don't know what the local St. Louis version of those is, but getting actually shelf space, or in this case freezer space, is really tough. And Schwan's has great tentacles into all of the majors, as well as the BJ's and Costco's of the world. To do that, they're willing to pay up to get a partner to invest alongside them in Schwan's. We took a look at the deal. We liked the business. We thought it was fine. It was not something that we thought that was, there was a lot of synergies that you had to believe for the equity story to work. So what we said to them, listen, we are happy to finance this and invest with you, but we would need some sort of a put option back if it doesn't work out. So we have a 3-year window where we have participation in the upside if it goes right. If it does not, if 3 years from now we look at it and the integration is not going well, we can actually put our stake back to them, and they have to pay us an 11% return over that time. It's then their CJ Group, which is the Korean conglomerate, is actually a AAA rated borrower. They're a very well respected business who has many business lines, but frozen foods is one of their largest. And so for us, it was great credit risk because our credit risk was basically to the AAA CJ Group, because we could put the investment back to them if it didn't work out. But if it did work out, and actually Schwan's business is doing incredibly well, and the strategy that CJ is pursuing of getting their frozen, mostly it's Asian frozen dumplings, into through Schwan's distribution has worked well, and COVID, quite frankly, has accelerated that with grocery delivery and a lot more frozen pizza being consumed. And so it looks like right now that we will, have the opportunity to convert to the equity, but again, we have lots of structural protections embedded so that on the downside case, we make an 11% kind of contractual return. Another good example, I think, of the cross-platform integration and work that we do on deals is Virgin Australia. So you may be familiar with the Virgin brand. It's Richard Branson's business. Obviously there's a series of airlines in different geographies. Virgin Australia is one of 2 major airlines in Australia, and Australia is a huge country. If you've ever been there, there's no rail system. Driving across the country takes days. And so they have one of the most profitable lines in all of aviation between Sydney, Brisbane, and Melbourne. And they have one competitor. COVID hit, obviously hit airlines really hard. And Virgin had a balance sheet that just had too much debt on it. And so we actually looked at the bonds, which had traded down and were trading at pretty deep distressed prices. We decided to pass on them and wait for actually the administration process to start. Thankfully, we did. The bonds ended up getting close to zero. But what we did was we bought Virgin out of the administration, which is their version of Chapter 11. And we're able to use our aviation expertise to basically completely recapitalize the business. We were able to renegotiate with their lessors who leased them their planes to variabilize the cost structure. So normally when an airline leases planes, they have to agree to a 5 or a 10-year lease on those. Because Virgin was very important and because the lessors were willing to be flexible with everything going on with COVID, we're actually leasing the planes by the hour. So we only pay if they're being used. And then, at the meantime, Australia actually got COVID under control. Air traffic actually started picking up again. They're largely a domestically focused airline. They do have a couple of international routes, which we actually stopped because their most profitable routes are within the country. And they've been able to take share from Qantas because we reduced their cost structure by about 50%. And actually now with enterprise values and values of airlines coming back, we're sitting on actually about a $4 billion profit, if you believe where airlines are trading today. So, but again, we had in that case, the valuation that we came in at was really our downside protection and gave us confidence that, to make that investment. And obviously we still have a lot of work to do, but that involved a lot of people from around our organization. And that's, your typical distress. And then deleveraging really is when the assets themselves are not distressed, but the seller is. And if any of you have followed GE Capital or GE, what's gone on, they've had to sell a lot of their non-core businesses. A couple of years ago, they sold their commercial finance business, which was one of their largest businesses, but to focus on, their really core industrial businesses. As part of that, they sold each business regionally. We were able to buy a portfolio of about 500 loans from them, senior secured loans against a whole variety of companies and industries at about a 20% discount to par. And that was a portfolio that was performing. It was not distressed, but because we were able to buy in wholesale, we were able to buy that package of loans from them at a really attractive discount. And that's, in that case, we had security against the assets, but we had somewhere close to 20 people from across the organization who worked on that transaction in the case of the GE commercial finance purchase. So those are the unique types of things that we're doing. It's diverse across geographies. It's diverse across deal archetypes. In all cases, we're trying to build in some sort of downside protection, but with upside, either through buying the debt cheap or having some sort of equity participation. So let me pause there. Can I answer any questions on anything I've covered so far? All right, Susan, if you want to maybe page ahead. So this is our first fund. We had invested in Asia out of our global funds prior to launching our first dedicated fund back in 2017. Really proud to say it fared very well through COVID. I think it speaks to the, having some geographic diversification in your business, also to having, really a downside protected portfolio. But we were also able to invest through and post-COVID as well and buy some assets incredibly cheap. But you can see it's diverse across the capital structure. It's diverse by the deal archetype, but also by geography, which is really important to us. It's important to note we don't do distressed in China. Mostly what we do in China is either performing financings or buying pools of non-performing loans. Doing actually corporate distress in China is not something that we typically do for a whole host of reasons that aren't really are worth going into on this 20 minutes, but I'm happy to follow up with. Typically, we target around 40 investments per fund. We do have the ability to recycle. It's a 4-year investment period, so you'll get some vintage diversification. We'll be deploying the capital over that, over a year or 2 years, and then we have the ability to recycle it as we get paid back on things early. And I think, there's not many funds out there that can provide this type of diversification in region, as I mentioned at the outset, which we think again provides another level of durability to the strategy. Maybe forward ahead one more. Move forward one more. So if you look at our track record that spans now going back, many years, but if you look at our whole body of work or our recent fund, we fare very competitively versus either private equity or credit. And I think one of the reasons for that is because the equity markets are also still pretty nascent in Asia. Getting getting private equity companies public or getting an exit can take a long time. And so IRRs actually historically in Asia have been a little bit lower than in North America and Europe on the private equity asset class. The beauty of credit is we have a contractual maturity so that we can control when we get paid back. And in many cases, we have that optionality, which is equity, and it may be worthless, but at least we're getting our credit return in the interim. And we've been very fortunate in that we've had a lot of cases where both have worked out, but in the cases where the equity story has not planned out, we've had at least the debt return to buffer our return. So it's the strategy has been very competitive versus both opportunistic credit as well as private equity. And we think, is very attractive for our money as well as our partners' capital for that reason. Our first fund has generated close to a 40% gross, 30% net return, and a 1.5 net multiple of money to our investors in just over 3 years, which for, again, a credit fund is, we think, very strong and competitive. But I think what we're most proud about is if you turn to the next page, Susan, is our batting average. And what we've shown here is just, we've arrayed our deals by return. And you can see in the sort of median case and the majority of cases, we've returned 10+% in our deals. And with the majority being between that 10 and 20, which is kind of where we focus, where our underwriting focus is. We're typically underwriting deals to a 15% plus return to get compensated for the illiquidity and for the risk we're taking by investing in markets that are less developed. In a number of cases, 9 cases, we've actually outpunched our weight and been able to capture that equity upside. But again, what we're most proud about, in only in 3 instances have we actually either just returned capital or lost money. And we would expect in every fund to have some deals that don't go our way. And so this may look different over time. We may have a few more deals, but the skew is what we look for. As long as the majority of deals are outperforming or performing in line with our case, that's what we try and deliver to our partners. And I have very few cases, because of the structural embedded downside we're providing through either the valuation or through the way that we've written the loan agreements, et cetera, the security on the assets we have, we've actually only lost money in just a handful of cases, and it's been small dollars. So I think that really speaks to what, the attractiveness of the strategy. And we're delighted that you're considering the fund. I know this is a lot to cover in 20 minutes or so, but I will pause there and answer any questions you guys have. All right, I must have covered it all. Oh, I think you're on mute, Kristen.
Sorry, I was asking if there's no questions. I know that was fairly quick, but given our time constraint, but I'm gonna, Chairman Sanders, any thoughts? Or
No thoughts at the moment.
Terrific. Well, Kristen certainly knows where to find me if there are questions that arise after I jump off. And we really appreciate your consideration. We'd be delighted to work with you. And regardless, as I mentioned at the top, we certainly appreciate all of your dedication and hard work during this stressful time.
Kyle, thank you so much for joining us.
Oh, I appreciate it. It's great seeing all of you. I hope to meet you in person sometime.
Absolutely.
Thank you.
Thank you,
Take
sir.
care.
All right, before we move on, I'm new at this, not the chairman thing, but I'm new at the investment thing. And the questions that should be asked, is there any question that you would say that we needed to ask Kristen, or maybe we should have said that before?
Sure. So I tried to tee him up. I just wanted to make sure you all understood the case for investing in Asia, understood what the components were. So I kind of asked that ahead of time so that he would cover that. My goal is just to make sure that you all feel comfortable with this type of investment. Now, this is a one-rated strategy at NEPC, so we have fully vetted them from an investment standpoint. But again, wanted to give you the opportunity to ask any questions. I mean, you know, sometimes you're not even investment. People say, well, the pandemic started there. What does that mean? You know, people come on left, right, up and down. So, but it's just your opportunity to ask and have that
Okay.
platform with them. So if there were no questions and you felt that he covered everything, that's fine as well. But, and I know, you know, I've talked about it and seen the material. And of course, you know, one of the reasons that you hire us, right, is to make sure that we're, you know, fully doing the deep dive. And so we have done that. So this is a very, very highly rated strategy for any PC. And you know, like I mentioned earlier, when we looked at your portfolio, thinking about what would be most value add, a niche manager like this compared to the fact that you've mostly done more broadly private debt, we thought that this would play well.
All right, thank you.
You're welcome.
Okay, we ready for contestant number 2?
Yep. And just as a reminder, they're not necessarily competing against each other. These are actually both recommendations, but do want you to meet them, feel comfortable to determine if you're gonna, you know, actually move forward with them. So,
Kristen,
yes.
Kristen, excuse me. You know, they have some quite a few communist countries there. Will there be a problem in getting our money in or out?
We do not believe so. We believe that this firm has, you know, a track record around dealing with countries that have different governance strategies or structures, or whether it be communist or not. The point being, they're only able to go into markets and provide capital in markets that are open. Okay. And so then they're doing the accounting. So that's a question that oftentimes comes up. And so, but yeah, so we vetted them for that as well, to ensure that the capital doesn't go in and then we don't see it again. So, but that's a valid question.
Okay,
Mhm.
I'm gonna admit Cray Hill. We got two folks coming in from Cray Hill.
Okay. Hi, good afternoon. Thanks so much for waiting and being patient with us.
Our pleasure. Thanks for having us. This is
Oh,
Carlos.
Yep, and nice to see you. And I'm Kristen from NEPC. So today, you have right around 20 minutes to talk about your strategy, the value add. You know, I've shared with them, you know, what you do, but you might want to just share a little bit about how you're going to be able to extrapolate returns for them, and then your competitive advantage. We're looking at about 20 minutes. They being the trustees might interrupt you during the discussion. Otherwise, they may hold the questions to the end. So, and again, thank you for your patience.
No, thank you, Kristen. So I'll jump right in. My name is Carlos Mendez. I'm co-founder of Cray Hill, and with me is my partner Shamafa Khan, who manages all of our investor relations and marketing activities. I'm going to and Kristen, do I have controls, or do you have the controls?
Yeah, I do. So you just let me know which page you want to go to, and
Okay.
take care of it for you.
Great, thank you. Maybe if we can jump to page 3. And please feel free to interrupt me at any time if you have any questions. Because yeah, that one right there. I'll give you a quick just background on who we are, a couple of vital stats on the firm. Then I'll go into a bit of the strategy, the team, and then contextualize, why we exist, and how Kristen pointed out, like how we're able to, deliver the returns that we do, and hopefully I'll have enough time to leave some time for some questions. But again, interrupt me if you have any in the interim. So in terms of our mission statement here, our focus is as lenders. So all of our investments are loans. The distinction being that these loans are made against pools of assets. So these are leases, receivables, commercial contracts, things of that sort. And so that's what we generally mean by private asset-based credit or asset-based investments. This type of lending is mostly focused within the specialty finance sector. And so these are companies that are they themselves originating that collateral. So they're non-bank lenders and firms that generally are fulfilling that need in the market, but need capital in order to fund those assets. So you will see in the approach section there, we mentioned a couple of the sectors that we're involved in. So trade receivables. So these are companies that are providing trade finance for the buying and selling of goods, and they fund those, they finance those things, and we're the balance sheet behind that. We lend against those assets. Or in equipment finance, where these specialty finance companies are lending in order to or leasing that type of equipment. Again, they need balance sheet, and we're the lenders against all of those individual equipment leases. And so you'll see that the general structure of our investments are, for instance, in our fund 2, we'll have 14, 15 investments. Those will be 14, 15 loans. They'll all be these segregated pools of assets, highly diversified, very granular at that level, and then our loan to each one of those. This is now our 6th year of operation. My co-founder and I had run the same strategy before at a prior firm where we had built that business up to just over 2 billion. 2.2 billion, and we're now in excess of 3 billion in total investments when you include the investments we made there, and here in terms of our total track record. This is a sector in terms of in terms of our approach that where we've made it our business to understand these types of companies, especially where they live and in these very niche industry sectors. So I mentioned, for instance, trade finance. It's our approach is very much a direct origination approach. Kristen, you mentioned how do we deliver our returns, our alpha. A large part of it deals with that upfront sourcing function, the ability to identify where there are funding gaps in the market, where are these companies growing and needing that asset-based finance. They aren't needing a loan to the company, so we don't do any corporate credit. That's not our business. They just need funding against the assets that they're originating, and it's been our business to go very, very deep in these sectors. I like to mention, like, when there was conferences, we'd go to the supply chain trade finance conferences. We would know who the valuation agents are. We would know who their consultants were, who their lawyers were, and if we saw an opportunity to finance those assets for them, we were proactively reaching out to them and putting proposals out. And that's the way we run our business today. We've been doing that for 11 years. And it's worked out really well. So we kind of have our lanes that we stay in and develop a lot of deep expertise at an industry level in order to source and originate these types of opportunities. You can see by the slide, while at Crayhill, we completed our first fund, and our investors in that first fund have primarily been insurance companies and pension funds. And in terms of our results for the first fund, we delivered just over a 13% return and a little bit over a 9% current cash yield. We would expect to deliver a very similar profile here in Fund 2, and our investor bases remain pretty consistent. So our largest investor is the state of New Jersey pension. But we have other pension investors such as Ohio Fire and Police, Ventura County, Hartford City, and then we have some large insurance companies, Allstate, Pac Life, and then fund of funds like Grosvenor out of Chicago, who's been a cornerstone investor for us in all of our funds, and even back at our prior firm at Magnetar, and other firms, other fund of funds, and wealth management firms like Iconic out on the West Coast, just to give you a flavor of kind of the institutional quality of our investor base. Today, we in terms of Fund 2, we're seeking. It's kind of, that kind of reads a little funny. We're seeking 500. We're at 570. So we're a little bit over kind of our target. We do have a hard cap of 800 million. I think Shinmafa would know better than I, but I think we're going to be pretty close to that in kind of the end of Q2. This fund has a 3-year reinvestment or recycling period and a 3-year harvest, so that's a total 6 years. But you should expect the returns to be in terms of the kind of a ramp over the first 2 years. Today, Fund 2 has 330 million committed already. And so we'll probably do about another 150 million over the next 60, 90 days. So we're pretty well on our way in that ramp. So we'll ramp up, we'll stay outstanding for about 3 years, and then we'll ramp down. So that's kind of the profile: ramp up and stay out, and then ramp down, delivering kind of a consistent 8 to 10% cash on cash along the way.
Hey, Kristen. Can we I'm sorry, I jumped in late to the meeting. Can we ask questions now instead of waiting to the end?
Yes,
So, sorry, I'm Christina Bennett. I jumped on late and
Hi,
I apologize. Can you explain again, this is a new class for us, and we have varying levels of education on investments when it comes to especially when it comes to this type of niche market. Can you explain to, before we go any further, what do you mean by credit recycling? And then can you explain, because obviously I don't know if you're the first presenter or the second presenter because I got on late, but can you explain what a special purpose vehicle is, and then what market you cover? Like, do you go worldwide? Do you go domestic? So I just didn't see that in the presentation, and I thought I'd ask those 3 quick questions and then let you continue.
Yes, and please ask questions anytime. So on the recycling, that's not unique to us or our strategy. It's more around just the fund. What I meant by that was just more around the fund structure. So during that first 3 years, if we have an investment that we make, and then it pays back within those 3 years, that we have the opportunity to actually recycle or reinvest that capital during that first 3 years. So that's all I meant by that. And then after those 3 years, any paybacks that happen just go to pay down the principal, and the capital is returned back to investors. So it's just more of a fun feature. Your second question around an SPV or a special purpose vehicle, these are structures that are used in order to isolate assets in a legal structure away from a company. So if a company is originating, let's say, trade receivables, obligations for companies to pay their goods in 60 days or 90 days, let's say that's the underlying receivable. Instead of leaving it on the company balance sheet, we actually segregate it. We put it into a legal structure where it's isolated, and then we lend to that vehicle. And that serves a couple of different purposes. One is it removes our risk from any of the operational risk that's happening at the company level, and just isolates our risk to the performance of those assets. And then secondly, we can then impute our structural protections at that level. And most of those levels, and I'll go through this as I go through the characteristics of the investments, but it's our principal protection where we put in capital below us. So if there's any losses in the receivables, the sponsor is absorbing those versus us. We also put in a whole host of controls around what assets can go in, and also protected provisions in terms of triggers, cash flow triggers, things like that. And I'll when I go through our the characteristics of our investments, I'll revisit that topic. But that's what we mean by the SPV is just the isolation of the asset in those vehicles. And then your third question around geography, because we're so, as credit investors and lenders, we're so sensitive to jurisdictional parameters around our ability to perfect liens, and to have a legal jurisdiction whereby we can affect our controls. So those SPVs, the asset sitting in there, if there's an issue and we need to take our asset and just say, look, we're just going to take the assets and liquidate the assets, and say that's something we want to do. We want to make sure we're in a good jurisdiction to do that. So that keeps us in the main jurisdiction. So we're in the US, we're in Europe, and in Australia. These are areas that we've been in, investing in for the last 20 years, where we feel we have really strong jurisdictions. In implementation, just because there's a lot of great opportunities right here in the US and in our backyard, we're like 75 to 85% US, and the remainder kind of split in mostly in Europe and Australia. So that's kind of the geo mix. And you're right, like this presentation has been pared down. We lost a lot of great slides that I wish we had in here, but that was definitely one of them. Maybe with that, Kristen, we can go to the next slide. I mentioned a little bit about our past in terms of having come from a former firm where we ran the same strategy and built a portfolio of just over $2 billion. I did that with Josh Eaton. He, before that, was in a similar strategy at a firm called Dune Capital. I was at an investment bank for close to 9 years, also trading a lot of these types of underlying assets, and as a banker, structuring many of these investments. And then we teamed up in order to start a fund complex and doing this type of business. We were joined by Joe Thomas, who was a prior CFO at his firm. And then Shamafa joined us from Barings, where she was focused on private credit funds. And recently, Scott Beardsley joined us as our COO from a firm called Blue Mountain. We've known Scott for quite some time. In terms of our relationships, Josh and I have known each other now for over 20 years. Many times we get asked why'd we leave. Our prior firm was called Magnetar. Why'd we leave Magnetar? And it was kind of twofold. One was around the market opportunity in terms of when you think about the types of firms that we provide these loans to, we finance their assets, these capital solutions. In terms of specialty finance firms, over the last 10 years have grown dramatically. The market's grown dramatically as generally banks have retrenched out of lending and leasing and receivables financing and these types of solutions, and private lenders have stepped in, and because they're private lenders and they aren't banks, they need balance sheet, and that's been a fantastic place for us to step in and provide that capital and make those investments. So one was a market opportunity, and two was just the way that the firms were constructed. Our last firm was more of a hedge fund. We're not a hedge fund. We're a credit lender, and we needed a better alignment of outcome to compensation. And so we've been able to accomplish that here at Crahill in terms of having everyone allocate or have carry allocated to them, such that, you know, there's no silos. Everybody gets compensated on the ultimate performance, you know, of the funds. And along the way, I think the other, you know, kind of the other thing that we, in wanting to do this in our own way, we also wanted to be independent. So our firm is 100% owned by management. We have no external stakeholders or any outside influences, in the firm. So that was another big, big thing for us to get done. Today, we manage close to, $1.2 billion. And Kristen, if you can skip to the next page on team. I'll go quickly through team and then step into the investment characteristics and revisit just how we structure these investments. So primarily, I think this slide's a little missing at least maybe one or two people. We're 20 people today. Roughly, if you look at our roles in managing the firm, I focus on the development of the themes that we're going to seek to generate investments in, and I work closely with Sloan and Stefan, who, Stefan came with us from our prior firm at Magnetar, and Sloan was at Oczif, managing a very similar strategy, actually exact same strategy. We competed against him. Luckily he joined us. So we together with some of the analysts focus on that front end. And then Josh, together with Raj and Dimitri, focused on the actual implementation of the investments, and really importantly on the risk management and the continued surveillance of the investments after we actually make an investment. By our process is we make a loan, perhaps maybe it's a $50 million loan or $60 million loan. Again, to assets, but day one, maybe there's only $10-15 million of assets in that pool. And over time, additional assets will be originated, and those assets will, like I mentioned, like trade receivables. So the underlying company will continue to make, these financing these trade receivables. The pools will grow. And so you need to manage the continued eligibility criteria. Are they the assets that we want? Measuring the performance. And so that's where, Josh and his team focus on that aspect of our investment process. A couple high level statistics in terms of characteristics of the team rather are that when you look at the backgrounds of folks, you'll just notice that in asset-based finance, that's all we've ever done. So everyone, I have a little bit over 20 years experience, and Josh as well. But if you look at all of our analysts, our mid-level folks, we all come from that asset-based finance background. And then you also notice that we also have we're all engineers. So if you look at all of our analysts, including myself, even Shamafa, we all have mechanical engineering, electrical engineering, financial engineering backgrounds. And it isn't because we're building bridges, but it is because this is a very quantitative endeavor in terms of the looking at assets, understanding how they're going to perform, and then making a loan such that even in the worst case scenario of 2008, 2009, we can sustain those adverse scenarios and not lose principal. And so that takes a lot of upfront work and ensuring that we understand the assets, we understand how they're going to perform, and then structuring a loan such that we can mitigate any losses again in those adverse scenarios. I'll skip to maybe unless anybody has any questions about the team, I'll jump into our investment characteristics. No? Okay. So I mentioned that in making these loans, we make these loans against pools of assets. And so I will just step through kind of the main characteristics that are common to all of our investments. And that hopefully will help you also understand the risk reward, that balance that we seek in the investments that we make. So in terms of the pools of assets, we're looking for a high level of understanding in terms of when something goes wrong in these assets, what is that loss given default? What is the propensity of loss? And when there's a recovery, how does that happen? So I mentioned trade finance. So in 2008, when there was a lot of stress in the market, how did these pools perform then? And then can we then take that math and then project it forward given the current environment? And if we can't do that, if there is no data and we can't access the data, then we're not going to make an investment. And so that disciplined approach to understanding the quantitative historical track record of those assets and how they're going to perform in the future has served us really well. The other aspect around the assets is just our knowledge and our comfort around the assets. The team, although we track in several different industries, the team tends to focus and align itself just around our personal experiences, in these asset classes. We've been around them for 10, 20 years. And we understand, the people around them, and how the business cycles affect the overall performance. Then once we understand how the assets may perform in these potential scenarios, then we can impute our structure on it for the purposes of protecting our principal. So I mentioned this before, this is where it's really helpful to take the assets and isolate them in an SPV before we make our loan, and then ensure that we have enough first loss, enough capital below us. So we're the senior loan, and then the sponsor who's originating the assets is the junior capital. And so that's
Can I stop you there and ask,
Mhm.
is this one you talked about, which priority return waterfalls?
If you think about how these structures are put together, they're very similar to the asset-backed securitization markets, where exactly we do use payment waterfalls in order to capture, when as the receivables, the underlying assets are paying principal or interest, we have a priority on principal. As a senior lender, we have a priority of payment on our principal and our interest before the junior capital is paid. So we do capture that prioritization by having a payment waterfall inside of the structure. And then we have triggers. So if the underlying assets start to default at a heightened rate, we can actually just stop any leakage to the junior capital, trap that cash for our purposes in order to protect us. And then, unlike the asset base, unlike ABS or kind of the public market securitization markets, in the private space, in our space, we're also able to have additional covenants such that we can actually put a covenant to be able to approve every single asset that goes into these SPVs. And that's really important because as you go along, we're making these investments and these loans are 3, 4, 5 years long. But during that period of time, the underlying assets and the composition may be changing, especially when you're ramping up and you're bringing on the assets in the first place. And so it's important for us to be able to have a process whereby we can green light every single asset, and we can assure ourselves that it's the asset that we expect to have, that the market conditions that now exist, let's say we made the investment a year ago, 9 months ago, that now, and there's new assets now coming into the SPV, that we can say, well, yes, this is consistent with what we underwrote, and we like where the market conditions are. Yes, we'll keep going. We also retain the right to protect our principal, that if it isn't, and we don't like the asset, we don't like the market, we can just shut it down and let it amortize, pay down its principal on its normal course, take our capital back, and then reinvest it. And so, and we've done that in the past, in not many investments, but in a few investments where we didn't like where the market was going. We let it amortize down. And again, we took our cash and redeployed it. And so when we think about principal protection, we think about those two things. We think about structural protections, the first loss, some of the attributes that we put into the waterfalls to protect ourselves, and then the covenants to control the assets, and ultimately, if we don't like it, to be able to get out. I'll step quickly through the next couple of attributes and then open it up for questions. The other is current income. So these assets are contracted cash flows. They're delivering cash. And so we make sure that we're providing that cash as a quarterly payment back to our investors. In Fund 1, we delivered a 13.3% IRR on that fund, but we also paid a 9% quarterly dividend quarter after quarter. So we target that 8 to 10% on a current basis income profile, and that's been very important for many of our pension investors. Upside optionality, we try to capture that in two different ways. One is you'll see that our loans against these SPVs typically are fixed rate, so they'll be 11, 12% fixed rate loans, and then we'll have what's called a revenue participation in the SPV. So if the asset yield is a little higher than expected, or the losses in the underlying assets, not our losses, but at the underlying asset losses are a little bit lower, they perform a little bit better, we can pick up a couple hundred basis points more of performance. And so we capture it in that way. At times, and this is probably 1 in every 4 investments, 5 investments, we may also take warrants in the sponsor. So the originator, the company that's, the company that's originating these loans, we can take warrants, penny warrants. We don't pay anything for them. They're kind of, just to have optionality, and especially if we can negotiate it at the time that we make the investment. If the company does, goes on to become a large company, many of the companies that we've financed over the last 11 years have gone on to become, $5-10 billion enterprises, that we have a participation in that. Now, that is not part of our target return. It's not, we value them at 0. So it's just pure upside, for us.
Now, is that I'm sorry, is that, I had a question on the warrants. So is that an upside for just the firm, or is it an upside for investors like ourselves, like on the warrant side? I mean, I know you value them at 0, but what if we're in this deal and in year 6 a warrant pops or does whatever? Do we get a part of that, or is that part of your back end compensation?
No, that's all in the fund. So
Okay.
yeah, no, that's all in the fund, for sure. The next point was self-amortizing exits. So here, this is really important from a perspective of the profile of the overall investment. And what we mean by this is that if you just going back to the analogy of trade receivables, those underlying receivables are paying off every 60 to 90 days. In one of our portfolios, we have over 100 counterparties that are in this one single SPV, which we're making a loan. And if we did nothing, if they didn't renew and put new receivables in there every 60 to 90 days, it would just pay back all our principal, and that's it. We would be out of the investment. But we allow them to continue to revolve that capital and reinvest at the SPV level, and it continues on. But when we get to the end of our loan, say in 4 years, that's exactly what we can do. We just say, okay, we're done at the end of investments, and the assets themselves will pay down, and we'll get back all of our principal and expected interest. But that type of profile, we ensure for all of our investments, and that way we're not dependent upon some type of refinancing, some sale at a multiple to book value, or something like that. That's very characteristic of corporate lending. So when people make corporate loans, they may be 3-5 year loans. Maybe there's a little bit of amortization, but they're really depending on the company to go out and get a new loan to pay back their existing loan. And that's a very different characteristic in our type of investment where we're not having to, not having to do that. The last point I'll mention is on risk management controls. Unfortunately, we don't have a lot of time today to show you everything that we do in this space. But one of the things that we do is once we make an investment, we go ahead and set up a risk management framework that includes an integrated data schema with the counterparty. So our systems are attached to their systems. We're pulling all of that data. We're then analyzing that data, certainly for eligibility, for conformity to the loan, things like that. But even more importantly, we're coming up with how do we look at that risk? What other outside third-party observable metrics or conditions can we look at to understand what's the risk in that portfolio? Not only then showing it back to us as the investment committee, and so we can make our decisions, but actually showing it back to them, showing it back to the counterparty, and saying, "Hey, this week this is how we see the world." And then every week we have a call with them and we're discussing with them that risk. We're saying, look, this looks good, keep going that way. This, not so much, don't do that, don't do any more of that. And we're managing those portfolios actively with them, and providing that view into how we're looking at it. And have served us immensely well, because we're able to provide a risk management service not only back to our fund and our LPs, but also to our counterparties, and to help them maneuver through the markets. And you can imagine, how valuable that was in March, April of last year during, what was going on with COVID. But we've built an extensive amount of infrastructure and systems and people and analytical tools to do that, and to do it at scale. It's unfortunate that we can't demonstrate some of those things to the team. Anyhow, I'll stop there and see if there's additional questions, or if I can provide clarity on any of the things that I'd mentioned before.
Any other questions?
Hold on one moment. I had a list of questions, but I got to log back into my computer to pull them up. Hold on. Let's see. Nope, I think he answered my questions.
Great. Well, thank you very much for having us, and we really appreciate the time. And Kristen, if anything else comes up, of course, just let us know.
Sounds great. Thank you so much. We appreciate your presentation and bearing with us through technical difficulties. So thank you.
No, not at all. Not at all.
Thank you.
Thank you.
Okay.
Bye-bye. Cheers.
Okay. So you were able to hear both of these presentations. As a reminder, they were not competing against each other. They both serve a different role, or would serve a different role in your private credit portfolio, as they talked a little bit about the niche strategy and the current income, and how they go in and sort of deal with these type of I don't want to call them distressed, but almost distressed companies. They have a track record. We spent a lot of time at NEPC going through this process to make sure we understood the strategy. And, we actually started, interestingly enough, the vetting of this prior to COVID, but going into COVID and coming out of it, this type of market is actually their sweet spot. So it was great for it to be revved up and ready to be invested in by our clients from the perspective of the due diligence that NEPC has done. And then, as a reminder, this is they are a Latino manager. Latino owned. Carlos is obviously Latino. And so we're always, of course, excited when we find strong managers that also have the ability to add more diversity to our portfolio. So again, both of these are, recommendations. So love to kind of at this point hear your point of view. But just as a reminder, our recommendation is got 10 million, and we would recommend 5 to Bain and 5 to Cray-Hill.
Let's see, Mr. Chair, co-chairs, I'd like to make a motion at this time.
Can we
I would
can we have
I'll
discussion?
let Angie speak. Angie has something to say
Oh, I
before we
didn't
make any motions.
hear her
Yeah.
say anything.
Well, really, I just wanted to say how it really heightens my appreciation of having an investment consultant and somebody on the board like Christina that understands a lot of these different types of markets. I could certainly understand better, I guess, Bain Capital and the way that information was presented. I thought it was very good, very smooth. And the Cray-Hill, it was difficult for me to absorb a lot of the information that he was going through. And I even hesitated to ask questions because I didn't even think it would help me if I asked the question. But when he said that they were a group of engineers and that kind of, I said, okay, all right, I got it now. But probably they're both great companies. And if that's what NEPC is recommending, then I'm probably comfortable going with 5 and 5 each. So those are my comments.
Angie, and I wouldn't feel bad or challenged that you didn't understand it. NEPC actually spent a significant amount of time. And one of the things that Oliver, who I believe has been before you all before, he continued to talk about, he's like, it's complex, the complexity, but that complexity is actually their value add. So it took those of us who spend our life working through investments a few times to kind of hear the story and dig in deeper. So it's probably very unrealistic that you would understand it in a 20-minute presentation, but of course wanted to, provide that opportunity to at least hear them and get a feel for what they are doing. And to your point, I think Christina asked some great questions to try to help to peel back the onion. But again, it's 20 minutes. This is something that I think Oliver spent 8 or 9 months working through it. So just to make sure, again, because you go through sort of our regular investment committee process, and then you go through operations due diligence committee process, and just making sure that everything lines up. In particular, when you start to look at securities and entities that in credit that may be a little distressed, right? We want to make sure that we don't have a high default rate. And so the nice thing is that they don't and the like, but I would not feel bad about that this was definitely a bit more difficult. Bain was more straightforward. It was Asia. You've kind of heard that story before. You just didn't hear it in Asia. So his big sort of ask, I think, for you all was just to explain why Asia made sense. So
Kristen, I was trying to, and I'm sorry I'm late because we had a press conference this afternoon I had to be at. They announced the new treasurer for the city of St. Louis, and next week we'll have the transition to the new mayor. So I was out of pocket this afternoon, but my biggest thing, so just to give everybody a background, I did asset-backed securities in a previous life about 20 years ago. And then I did structured finance and structured credit when I was before that. So I understand both policies pretty well. And that's why I asked some of the questions, because a lot of presenters forget that the educational level is very different and they start using technology or terminology that most people don't understand. So the what I liked about this compared to what I did with asset-backed securities is that they're in the first position no matter what. And what I didn't want to say in the presentation to the presenters was it's kind of like a forced marriage, right? When you have to go seek some of this funding, you're in a forced marriage for 3 to 4 years, and they have the upper hand. And when they said they can control, I didn't hear Baines, and I apologize. But when they can control what goes in and how to turn off the spigots or whatever, that's a pretty well-oiled machine. which really protects the downside on this investment, which I really liked, especially on Cray Hill. I kind of liked, again, right, left, right brain, left brain. I really liked Cray Hill's presentation, and I could go through it and I was like with it. And then I got stuck on Bain's presentation, right? Because it's different marketing styles and presentation. And I apologize, I didn't hear it. And that's why I asked about the geography. I got this whiny dog here that won't be quiet. And so again, if you can just brief me why Asia. I mean, I like them, on paper, I like them both, but I didn't hear why Asia. And that was going to be one of my questions. Like, if Bain is local, and I'm assuming they were local US, Europe, domestic kind of more, what was the rationale behind Asia and the expertise regarding that? Because it's a bigger market, it's still underdeveloped, and I didn't know what percentage of the Asia market was still emerging, if they did anything in the emerging markets. So I had hoped to send all these questions over to Sheila and whoever before, but if you can explain that, but I'm comfortable with either 5 and 5.
Sure. So,
Okay.
I mean,
Oh,
go ahead. Go ahead, Sheila. Please go ahead.
my hesitancy with Bain is coming back to the communistic atmosphere. The delivery of our assets when needed. Will they be able to do it when we need it? That's one of my hesitancy concerning that. And then with Cray Hill, I didn't quite understand the strategy. I'm going to be open with that. And as you said, in 20 minutes, we can't pick it up. So for me to just go ahead and say, okay, we're going to split it. Maybe I need an overnighter to let Cray Hill sink in some more. But it was too much for 20 minutes for me. I couldn't go with it. And I'm still cagey about that, the pink countries, okay? As Christina said, why Asia? Right? That's my take on it.
Could I have the floor now? I just want to say that I was very impressed with both of the presentations, and I'm going to bank on NEPC at this particular juncture and the research that they have done. And so I want to do a split as far as my vote, to do a split of 5 million for Bain and 5 million for Cray Hill. And again, I'm relying on NEPC and the research, the 8 or 9 months of research into those two investment companies. And so that would be my support. That would be my vote and support for both at a split of 5 million each.
So
I agree with you too, Louis. And Christian, did you mention before in another presentation that Asian market was doing well?
right. So,
Okay,
so if you ask,
okay.
Somebody got some static in the line.
So if you ask why Asia, which I think is coming back down to that question. So Bain, first of all, it's not just China. It is across multiple. There's some India in there, a little bit of Japan in there as well. So it's not, I think their last fund was about 40% China. Could end up being a little bit larger going forward. But, we will see. They do have that latitude. But when you ask Asia, and I think they had a few slides around this, the Asian market is double what it would be, or almost twice as much as the US and European market as it relates to opportunity. And then when you look at those that are investing, I mean, there is a point, do you have that expertise to go in there? We have deemed that they do have that expertise, and the market penetration. I mean, when you look at the slide, it dwarfs, where the opportunity is versus what has actually been penetrated. And then when you overlay that with the fact that even if you think about China and where that's going in the next 20 years as it relates to GDP and the contribution to our the contribution to our economies, the global economy. I'm sorry, you all can't hear that, can you?
That's okay. It's fine.
You can't.
Yeah, we can hear your puppy.
It's
Mine just,
fine.
I kicked him out.
They can hear you, Liam. Shh, type it down, please. Apologize. So, basically just thinking of the penetration, the opportunity, the fact that, can we do well without investing in Asia? Sure, but we are leaving a whole market of opportunity on the table. And so this is why you're going to hear more and more about Asia. I mean, this year we're actually even recommending, and it's not for everybody, but for some, China dedicated investment managers. That's new, right? And that comes back to what we talked about almost 2 years ago as it relates to the opportunity set, and either we are going to participate with Asia or we're going to kind of float side by side. But from an investment perspective, into the country and with the country, the rest of the globe is participating with them, and they can actually, Asia can actually invest with Europe, Russia, and Africa, and not even worry about the U.S. and still be fine. So it's just one of those things. Are we gonna jump on the bus and go forward, or are we gonna be left behind waving and they will be bye-bye? So I say all that to say there is definitely more focus on identifying strong managers that focus in on the Asian market. This does give a bit of diversification, though it is not just specifically China.
Yeah.
Does that answer? I hope that answers that question.
Well, for me, I just realized it. Yeah. So so China's going to be about 25 to 30% of the portfolio. But they do, what I really am now looking at is that they do have India, which is an amazing market. Australia, Thailand, South Korea, New Zealand, and Japan. Japan's very small percentage. I mean, less than 5%. But when you look at, the other ones, I mean, Thailand and Australia and India, if you needed to diversify, that's a pretty good market as well. And so, I mean, I liked them both when I read it last night. I guess my comfort, right? My historical comfort was Crayhill, because I never did China, right? I did domestic asset-backed securities, which was simple to compare to. But I mean, I'm totally comfortable with a split, just to diversify our portfolio. This doesn't compete with other emerging market or international products, because this is very specific. This is kind of, whether I didn't hear Bain's presentation, but I know that I really like how they capture the client and really make sure that they're senior position. And I'm assuming that's what Bain said as well. Mm-hmm. Mm-hmm. So I'm comfortable.
One more question, Kristen. How are they for diversity? How do they stand?
Well, Crayhill is a diverse firm. Mm-hmm. So Carlos Menendez, and he is Latino. Mm-hmm. I would have to ask. I feel like it might be Mexico, but I don't know exactly. But he is of Latin descent, and I think it's Latin American descent. So not Spanish is, I guess, what I'm saying, not Euro. The other Bain, Bain is, I wouldn't say that they're arching on any sort of diversity. They have some women. They're working through it the way the rest of the investment industry is. So,
Kristen, I would say that they're not what we consider domestic diversity, but they are international diversity.
Yes.
Right. Yes, so they have a lot of. When I look at page 9 of their staff, I mean, they have people in India to cover India. They have people in Thailand to cover Thailand or China or Japan. So when I look at, and I'm making assumptions off names, but it looks like they're building their diversity within the specific markets that they are in. And, we're going to start seeing that diversity is global diversity and not just what we're considered as domestic diversity. Although having Crayhill as a domestic minority manager gives me great comfort. Even, so.
I'd like to, if there are no further questions, I'd like to make a motion that we split the $10 million and to provide $5 million to Bain and $5 million to Crahill for investment.
And I'm sorry, I'm going to jump in. I think we probably need to do a separate motion for each.
Okay.
Yes.
Then I'd like to make a motion that we accept Bain as an investor at $5 million.
I second.
Okay. Angela Banks,
Yes.
Christina Bennett,
Yes.
Lewis Cross,
Yes.
Sheila Goodwin,
Yes.
What was that?
was that a yes or?
Yes, that was a yes.
Okay. Okay. Sorry. Donna Jones,
Yes.
Bobby Richardson,
Yes.
and Albert Sanders.
Yes.
So we have 8, the motion passes.
Okay, I'd like to make a motion that we accept Crahill as an investor at $5 million.
Richardson second.
Okay, Angela Banks,
Yes.
Christina Bennett,
Yes.
Lewis Cross,
Yes.
Sheila Goodwin,
Yes.
Donna Jones,
Yes.
Bobby Richardson,
Yes.
and Albert Sanders.
Yes.
So we have 7, so that is a yes. Motion passes.
All right. And Susan, on that last one, you said we had 8.
Yeah,
Should
I
there be 7?
apologize. It is 7. I
Okay.
apologize. Yes.
Okay.
Okay.
So now we take that to the full board, right?
Yes.
Okay.
All right. And I think now we're going to move on to Kristen, and you're presenting something else, correct?
Yes.
If that's okay, Christine. I'm sorry, you're here.
Oh, hey, I'm just a board member today. I'm relaxing. You and Sheila go right ahead.
So I wanted to just talk about the GAA Global Asset Allocation Manager Review. Right now, you have a target of 5%, and you have 3 managers, which means they all have like something like 1.4%. It's just unnecessary to have it split up that way. And so maybe, Sue, if you can move forward on the slides. So just to give you kind of executive summary, as I mentioned, you have a target of 5%, though you are actually at 5.6%, which is approximately $51 million. So that split up 3 ways is, it's just overkill. We had the 3 managers in place because when we entered this asset class or strategy type in approximately 2006, we had a much larger target at 10%, and there were times in which we went to 2 or 3 percentage points over that. So with that in mind, my recommendation is that we reduce this to 1 manager to a $50 million allocation. Of the 3 managers, and I kind of list this on the key observations, Mellon has probably done the least as it relates to performance, and we can kind of go through that, but high level, it's about 50 pages worth of backup information to come to these conclusions. But essentially, Mellon has done the least over the more near-term time frame. And hold on one moment, I'm sorry. Apologize for that. PIMCO has the strongest risk-adjusted returns, looking at their information ratio and their returns, as well as the risk that they're taking on for the last 3 to 5 years. When you go over longer time periods, GMO, it sort of flips, and GMO is the one who has the stronger performance over time. Now, they're pretty close. When you think about the correlations between PIMCO and GMO, so let me take a step back. When you look at it, all 3 managers, because they are GAA managers relative to the total portfolio are going to be somewhat similar. But as it relates to the ones that are most value add, which means they're going to have the lowest correlation to the other asset classes, any or other managers within your portfolio, that's going to be PIMCO and GMO. And so, you know, then to try to take that decision tree a little bit further, I would be remiss if I didn't mention, and this is, you don't have to make a decision on this, but you know, I do need to make you aware that PIMCO currently is on watch for NEPC. We do not think that they're going away or anything. They're a huge firm. That said, they have what we call an unfavorable news trigger. And so they have had some issues in the past, and they continue to have these issues, these allegations around discrimination and harassment. They are allegations, so they have not been proven yet. So we don't know what the outcome is, but what we know is that this is not the first time that these type of allegations have raised their ugly head. And so we take any sort of allegations like that very seriously. And so because of that, right now, NEPC does have a watch on it, which means that they actually wouldn't be put in a new book if we were starting from scratch. Now, you already have them. And so from a performance standpoint, they have done well, but I do need to make you aware of that. So if you move forward, Sue, and kind of, so again, all three strategies are on our preferred list. And you know, GAA means that you go anywhere. So that means that they're going to include both equities and fixed income. And maybe actually we should go a little further, because if I could talk about the benchmark, if you know what, I mean.
Kristen, hey,
yeah.
Kristen, do you have a new analyst? Because I wanted to be like, yo, we haven't seen some of these presentations. And what was it? The one that talked about plus or minus the benchmark. And if somebody didn't read that, you would be like, how can I have been negative for so long, right? So my only recommendation is when they compare that, compare it on the same sheet so that people can see the benchmark and then the variance to the benchmark and see the correlation on that same page. But if you have to flip a page and then you start seeing negatives, or like, I was like, that's not the best way to present, even if the font was a little bit bigger. Because for most of us, you know, we're not seeing this on a regular manager search. We're not seeing that variance to the benchmark, which obviously they put it in paper, but we can look at it ourselves and see plus or minus the benchmark.
What page are you talking about specifically?
Hold on, let me go. I took my little, correlation chart on page 11 and 12. We haven't seen this correlation chart before. And then page 17. My comment was this slide is horrible, but it looks horrible even though it's just a correlate. Well, okay, so the correlation, we've never seen this chart in our recent presentations, and there's no color coding of what it even means. So so again, that's why I asked if you had a new analyst, because while I love correlation charts and I know what it means, we haven't had the training to understand what this looks like, and why is there a 1 going diagonally all the way through, and what does yellow, orange, and green mean? So so I just wanted, and I know that in one of the charts it has it at the bottom, but it's something that we have not gone over, and this is a good, educational tool that we can go over. But I don't know how many of you skipped through this, like I have no idea what that means. So I just wanted to let you know that.
Sure. So no, we don't have a new analyst, but I will pass on that information, because you're right, there should be a legend on the bottom. And I did not catch that it wasn't on there, but it is standard to be included. So we'll make sure that, there's a legend on the bottom. Let me write this. So that we could actually address. And so maybe take a moment to actually go through this. So these two charts, one is for 3 years and one is for 5 years. The red one means sort of that 100% correlated. And so if you think about asset classes, what we want to have is different asset class. We want to have asset classes and strategies operating differently. So that means they're doing different things versus doing the exact same thing at the same time. So one is going to mean that they're highly correlated. They're going to do the same thing at the same time. Green, if you look and you see the greens are going to be the lowest correlated, which is good, right? So when you look at Earnest Partners compared to Causeway at the very top, okay, you can see that if you look at Causeway, the first manager, and you scroll over to Earnest, 1, 2, 3 over, you see a 0.06. That is saying that they're very low correlated. 0 would be 0 correlation, which is what you're trying to do when you're thinking about managers operating differently. So with that, so red is going to be 100% correlated. Green is going to be, getting close to 0% correlated. And then yellow and orange fall in the middle. Orange is going to be closer to red. So that is sort of that next quartile of correlation. And then yellow will be closer to green. So it's green, yellow, orange, red, with green being the best and the lowest correlation in this situation, and red being the highest correlation at 1, okay, or 100%. So that gives you what the color coding is. We looked at all of the managers. And so when you look at PIMCO, GMO, and Mellon at the very end here, because they are GAA managers, they're going to be fairly correlated to each other. But what you can see is that when they're uncorrelated to some of your managers, you can see the variance. So I'm going to pick Earnest again. And so when you look at PIMCO, it's 0.26, GMO 0.18, and Mellon 0.15 as an example. Very similar in this particular case. Actually, Mellon is going to be the least correlated. But when I looked through all of them together, my assessment was that, and looking at both 3 and 5 years, that PIMCO and GMO were slightly less correlated than Mellon. But then coupled with that, Mellon also has not done as well from a performance standpoint. So that's what those mean. Now, as it relates to page 17, Christina, that one's going to be a little more difficult to challenge because that is a formatting issue. Like, there's no way to really change those pages. I mean, I'll ask, but my understanding is they're not. I don't love them either. But and what we do and what you have to do for these is you really have to read what it's saying. So calendar year returns net of fees, as an example, versus gross of fees. Sometimes we say least common time frame, which means that if you have 3 managers and one was 2018, one was 2017, one was 2016, when you're looking at the performance, you're really going to only look at performance when all 3 strategies were live, which would be only 2018. That's not necessarily the case here, but I'm just sharing that information with you. So maybe we can go, and maybe what we can do, so there's a lot of background data up here, but maybe what we can do, let me tell you, Sue, what page to actually go to that I think would be that it's the easiest way to look at this is when you go to page 27, 28, and 29, and 30. So when you look at 27, you start to see compared to the benchmark. And then if you look at the benchmark, it's 60% MSCI ACWI, which is All Country World Index, which is a equity benchmark. And then you have 40% bonds, basically. So 60, so that just shows you there's multiple things in there. So in this case, they didn't do quite as well, which is one of the reasons we've reduced them. They don't tend to do as well when they being GA managers, when the markets are just going straight up and up and up. And that's what we've seen. If you return the clock back, there's a period of time where there was a lot of volatility in the market, equities wasn't doing well, and and they were doing great for you. So these managers have added a lot of value to St. Louis. It's just been a difficult market for them to do so in more recent time horizon, which is why, and was the catalyst for us reducing them in their reducing GAA managing your portfolio, coupled with the fact that you now have more asset classes. So GAA also has the benefit of you don't have to go out to RFP to get certain asset classes. It's part of what the manager does. That, like I said, we've taken the handcuffs off and we've kind of let them go a little, have more latitude about where they can go. Which again, when you want to make quick moves because the way the market is going, that's great. That said, you do have a lot more dedicated managers within your portfolio at this time. So that's another reason why, we recommended that you bring it down from 10% down to 5%. And given it's 5%, you just don't need all three managers. It's just more to keep up with. And so when you look here, you see that PIMCO, in the 3-year time horizon has done the best with slightly less risk. GMO not far behind, but Mellon has definitely trailed a bit. And Sue, you can maybe turn to the next page. You see the same thing is the case, trailing a bit more when you look at the 5-year time horizon, and I'm talking about Mellon. And then when you go to the 7-year, now you're seeing GMO and PIMCO almost on top of it. Mellon has done a little bit better during that period of time, but it's been, I think, very volatile. And then when you move forward onto the 10-year, now you see that GMO is sort of leading the pack. So that's really the data that's going to get you to where that decision point is for these three managers. Given the issues that PIMCO is having, I would be comfortable with you all moving with GMO should you want to do that.
If there are no questions,
I'm sorry. So repeat, you said that you would make the recommendation to go with PIMCO?
No, I'm saying given the issues that PIMCO, PIMCO's got a lot of headline risk right now.
Yeah.
And so you all have to be comfortable with that. They're and the headline risk is around discrimination and harassment. So that's challenging.
Yeah. And I think when I read all that and I read the details, it's coming out of one office. It's not like a consistent trend across the company. And I think that we're gonna see a lot of, unfortunately, a lot more of these with the focus on diversity, inclusion, and closing the wage and gender gap going forward, because we know it hasn't existed. I mean, we know that these type of issues have been out there, and God knows that I've had to fight my battles in the past, but we don't have a national movement focused on it, right? So for some organizations, I think that these type of issues are going to come up. I do not by any means say that, that I like the headline risk. But we've been in this asset class since 2006, I believe. And PIMCO's been a great performer. And I would hate to make a decision based on right now what I consider a lawsuit, not a class action lawsuit, for us to turn performance away, in which the performers that are running this is not necessarily who is managing our money. So I just wanted to make that comment and let others provide comment.
Could I have the floor? I just wanted to say, since PIMCO is on the watch list and also is in some possible heavy duty litigation, I was thinking that I'd prefer that we move to the, what was the other one, Kristen?
So you have GMO, you have Mellon, and you have PIMCO.
And which one is the best performing of those?
So really, PIMCO and GMO are, tied depending on what day of the week you're looking at. I mean, if they did not have litigation, I would hands down have probably recommended that you move forward with PIMCO. I'm being sensitive to the fact that they have this litigation. Now, the other option here, so I just really feel strongly you just don't need to have three firms. While there could be a preference, and I was recommending that you do one firm, you can do, there's still the option of keeping two firms. And so until the litigation goes away, if you will, if you'd like to keep PIMCO and keep GMO, or, again, I'm not going to get in the way of PIMCO. PIMCO is a strong firm, and I don't believe PIMCO is going anywhere. I'm sure they're going to have to get their act together. They're too big of a firm and have tentacles. They're one of the largest fixed income shops that we got. They do this well. They do their all asset has been, which is what you're in, has done well. But they've got some issues that they need to deal with from on the other side as it relates to HR. And you're right, Christina, who knows? GMO could come up with this tomorrow too. I don't know. I don't work for either of these firms, but we are in definitely a different environment where harassment and discrimination is no longer going to be tolerated, period. And so I suspect many of these firms are going to start to have more and more issues. So I don't want you to feel that I'm deterring you away from PIMCO. I just wanted to lay it all out on the table as my responsibility to make you aware.
Well,
Right. Like, so Lou,
in response to that, I would say that I would prefer to go with the other two firms and move from PIMCO until they clear out whatever issues they have, and then we can then revisit it. That would be my my recommendation.
And Louis, I totally changed the market here. So imagine, right? Let's say we don't bank with Bank of America, so it's easy to use them as an example, right? Bank of America is nationwide. They have products and various things. PIMCO is a very, very large firm. Now, if the Bank of America in St. Louis had a litigation, would you pull? Or let's say that they had litigation in Nashville. Would you go down the branch and pull your money from Bank of America and before you know what the outcome of that litigation is? Or and so that's when you look at the size and you look at the fees and you look at the returns, PIMCO is definitely the better manager. And when I am very sensitive to litigation, I'm not knee-jerking and picking a less performing asset that has higher fees because of an office in one office that has litigation. Now, again, PIMCO, we've rode the wave with PIMCO. I was more at risk with PIMCO when they lost their portfolio manager years ago.
I remember that.
And we stood by them and said, let's see how they do it. They've done a great, performance for us. And who manages our money is not the office or anywhere near it, or we don't even know the details of that regarding this firm. This firm, if you look at, Kristen, if you can show the size of these firms, I don't want us to make a knee-jerk reaction on a litigation case.
I wasn't making it on a knee-jerk. I was making it on the other issue that PIMCO is on the watch list as well. And
right. Well, anything that causes headache.
May I interject for 1 second? I'm sorry, just to be clear, just so we are all clear. They are on the watch list presently because of this unfavorable news. So they're not on a watch list because of any investments. They're on the watch list because they have these allegations around harassment and discrimination. So just to make sure you're clear as to what the trigger is. It's not for investment reasons.
So Chris, you're saying we'll write them out?
Excuse me, Kristen, excuse me. Let me get this clear. PIMCO is on the watch list not because of performance. There's nothing wrong with your performance. Is that correct?
Correct.
All right. Okay. Let's move on.
All right. So Chris, I'm asking you. So you're saying your recommendation would be to write them out?
Well, my recommendation is, like Kristen said, we don't need 3, right? But I don't want to exclude it. So I'm comfortable going down to 2. And once this litigation of PIMCO, either it blows up, right, or it goes away, right? Then we can make the decision to go down to 1 manager.
So you want to do and what other one?
Yeah, well, GMO, right? I mean, GMO and PIMCO, again, like Kristen said, those are higher performing managers. Mellon has been, okay, that, we took its course with them, but we don't need 3. And if our short-term goal is to keep 2, our long-term goal is to go down to 1. And I don't have that problem at all.
But then well, let me change. I would say I recommend that we go with PIMCO and GMO as the two managers and to drop Millen.
And
That's
we do have Mellon, we have investments with Mellon and a couple of other
right.
categories, so
Exactly.
we wouldn't be totally,
It wouldn't be total.
just in this area.
But that's so my recommendation would be PIMCO and GMO for this particular investment area. Can I get a second?
That was a recommendation. That wasn't a motion.
Oh, okay. I'd like to make a motion that we move from the three managers to PIMCO and GMO and to drop Millen in this particular strategy.
Sheila Goodwin, second.
And Kristen, would you recommend reallocating the assets to the other two managers, or what would you recommend?
At this point, I would recommend,
Christina, we have a motion on the floor.
We do, sorry.
Okay. And it was seconded.
I was just trying to
I did.
ask question, because you go from motion to questions to
Right.
be able to capture any changes or friendly amendments so that we can, so that was my question to Kristen before we vote on the motion.
Right.
Okay. So, Kristen, what's the answer to that as far as allocation?
I would reallocate. Right now you have a 5% target. So I would reallocate a portion of them. You're a bit overweight at 5.6. So I would only reallocate up to 5.
Okay, so is that in the motion I made, or do I have to motion?
No, this is the question to the motion.
Exactly.
So Louis, you can amend your motion.
Okay, I'll amend the motion and I'll go to 5% at a max for GMO and a 5% max for PIMCO as an amendment to the motion.
No, Louis, you got to change that.
No.
So
Okay,
let me tell you what the motion
let me withdraw.
should be.
Let me withdraw the motion and let's start over.
Okay, so the
Okay.
motion would be to retain GMO and PIMCO in this asset class with a reallocation to not exceed 5% of our portfolio or per our asset allocation.
Okay, is that a motion?
Yes.
I second.
Is there any other discussion?
Question? Any questions? Okay, I think we're ready for voting then, Susan.
Okay, we'll do the roll. Angela Banks,
Yes.
Christina Bennett,
Yes.
Louis Cross.
Yes.
Sheila Goodwin,
Yes.
Donna Jones,
Yes.
Bobby Richardson. Did we lose Bobby?
Yeah, I don't think Bobby's on.
I think she dropped off.
Yes, there is. There she is.
Yeah,
Yes.
so you're yes, okay. And Albert Sanders.
Yes.
Okay. So again, we have 7, so the motion passes.
Okay.
We'll bring that again to Monday's board meeting.
Okay.
And I would like to thank Albert and Sheila for stepping up to the plate. I appreciate, Sheila, the email. And I really love the cooperation and partnership that we have on this board. So thank you very much.
You're welcome, Chrissy.
Thank you, everyone.
I tried.
Good job, Albert. Good job.
If
Good
that's
job, Doc.
if that's
You
it,
made
I'll
it.
make a I think we're finished with our agenda for today.
Okay, Albert, I just wanted to say something to you. We really enjoyed you today on Channel 9. My granddaughter and I, she's 7. You were so animated. You were really good in your delivery. We appreciate that.
Thank you. Thank you very much.
Yeah,
Oh.
you were. It's amazing. That's all I can say. Very amazing with those kids and what you do.
I told you he's a serious guy. Don't pay any attention to his wife with his jokes.
Okay.
But I think our agenda is done for today. We have a meeting on thing where we'll bring some of our motions to the overall board. So I'll make a motion right now to conclude our investment meeting on April, whatever today, 15th, April 15th, the old tax day.
I second.
I'll make a motion to conclude our investment committee meeting for today.
I second.
I started.
All in favor?
Thanks, Susan. Aye.
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 See you on Monday.
All right.
Okay.
Good night.
Yep.
Thank you,
All
Ms.
right,
Nana.
we'll see you all later.
Bye-bye.
Take
Bye.
care.
Thanks, Al. That was fantastic. And Kristen.
Yeah, thanks, Kristen.
Oh, happy to do it. Thank you.
Worked out well. Sorry about the technical difficulties.
No problem, Sue.
We're good. We got the decisions made, so we're good.
Very good.
All right.
All right,
Have a
take care.
good weekend. Take
All right.
care. Bye-bye.
Bye-bye. Bye, Sheila. Take care.
Bye, Susan. You